this. Boom. Okay. Let's get started. Welcome, everybody. My name is Anthony Price. Today, we're going to talk about 5 little-known tax deductions, which are proven strategies to save $10,000 to $20,000 or even more on your next tax return. So let's get into it, starting by learning, first of all, who I am. My name is Anthony Price. I graduated with my finance and my accounting degree from the University of Nevada, Reno, economics minor. I just love money. I love learning macroeconomics. I love business and entrepreneurship. And I've always had a knack for numbers in finance and accounting. So I actually was about to graduate with just my finance degree, but I had no idea what I was going to do afterwards. And so I decided I would go back. I was going to graduate with my finance degree in just 3 years. And I decided, I don't really know what I'm going to do. I'm going to spend 1 more year and graduate with my friends in 4 years. I'm going to go get my accounting degree, and I'm going to spend that entire senior year, because I only had to take a couple classes to get my accounting degree. I'm going to spend that entire year learning how to, what I'm going to do next with my career. And so finally, in my senior year, I figured out what I was going to do. I decided I was going to be an insurance agent. And so quickly, after becoming an insurance agent, I started going to some CPA and accounting networking meetings. Oops, did I lose my presentation? Oops, sorry, I lost my presentation, guys. Let's see, I accidentally shared it with James. Here we go. I'll keep going as I get this fixed. Okay, so I decided I wanted to be an insurance agent before I finished my accounting degree. And so I went to one accounting, like Beta Alpha Psi, it's an accounting fraternity or group in college, networking event. And I decided right after that, you know what? I like insurance. I'm doing too well there. I'm an entrepreneurial guy. I like to go and meet people and make relationships. So I don't think I want to go to any more of these Beta Alpha Psi meetings. I'm just going to focus 100% on insurance. But from that one meeting that I went to, I met a ton of people and I followed up, and eventually they asked me to come in for an interview. So right after I graduated, I went in for an interview and let's see, there's the screen. So I went in for an interview and I got the opportunity to learn about taxes and to get my CPA, and really got to flex and work on my technical skills, on my CPA skills, and also work with entrepreneurs. And so I decided that I would go and learn how to be a CPA, how to do public accounting, so that I could flex both my relationship building skills and my logical technical skills as well. So quickly, once I got into public accounting, I realized that that was not really the life for me. And the reason why is because I didn't want to sit behind the computer my entire life and not talk to any people. Some people might enjoy, sitting behind the computer and not talking to anybody, but I started to get bored. I started to get lonely. I wanted to work with people. I wanted to run the face-to-face communications, and I really wanted to make a serious difference in other business owners' lives. So I decided quickly that I wanted to go the entrepreneurial route. And so right after I got my CPA, I quit and I started my own firm so that I could start serving clients myself and teach them how to implement the same tax saving strategies that I am implementing for myself as an entrepreneur. Because if you'll learn anything, you'll learn that the IRS is rewarding investors and they're rewarding entrepreneurs when it comes to the tax code. The best tax saving strategies are for investors and they're for entrepreneurs. So that's what we're going to get into today. Just wanted to give a little bit of background about myself. I work with high income, high net worth serial entrepreneurs. I work with a ton of crypto investors. I work with a ton of real estate investors as well. So we're going to go over strategies that discuss essentially all of those types. Quickly, let's go over the tax basics. First, the IRS says any expense that is ordinary and necessary in your pursuit of profit and in operating your trade or business is a eligible deduction. So of course the IRS says that anything anything that, they've got some set categories that they expect. They expect you to have maybe office expenses or legal and professional expenses or supplies or depreciation. But if you have something that's way out there that still is ordinary and necessary for your business, of course, you can take that deduction. So like I said at the beginning, it's all about the story that you're able to tell the IRS. Why is this necessary? Why is this an ordinary expense? Why did you have to pay $15,000 for consulting? Well, it made you into a better professional where you were better able to make profit and make revenue. So you can be creative within those rules. You just need to understand what the rules are and then learn where the points of creativity are. So any expense that is ordinary and necessary to you making a profit is an eligible tax deduction. We have a couple more people coming in right now. Welcome, guys. Anthony Price. We're not too far into the presentation right now. I just introduced myself, Anthony Price, CPA. Feel free to take a look at my LinkedIn page and see some of my background. So documentation and record keeping are the most important thing that the IRS is looking for. Me as your CPA, I can rely on statements that you give me. I can rely on the information that you give me. As long as it doesn't seem egregiously fraudulent, I can take the information you give me and put it on your tax return. You, as a taxpayer, bear the responsibility for the assertions and the representations you make on your tax return. And if the IRS ever comes knocking, while I don't have to rely on your documents and records, just on your assertions, the IRS is going to say, hey, what documents, what records do you have to support the deductions that you've taken? So something I'll continually repeat, and I will go over what documents are necessary, what records are necessary in order to support your deductions with each of these strategies that we're about to talk about. And so I'm, of course, a tax professional. I give tax advice for a living, but this tax advice is not specifically tailored to your situation. So of course, always consult a tax professional. Hopefully it's me by the end of this presentation. So let's get into some commonly well-known deductions really quick. We all know depreciation. We're actually just talking about that quickly, where you can buy fixed assets, whether it's for your business or whether it's for another business venture, and the depreciation will give you a significant benefit. Because with bonus depreciation, we're going to talk about that with the auto deduction, you can depreciate 100% of the purchase price of the asset you're purchasing that is going to create passive income or income long-term, but you can get the immediate tax deduction right now. And so that's a big thing in tax strategy, is what's called the time value of money, because that concept in finance is $1 today is worth more than $1 a year from now. Say 5% or whatever the risk-free rate is, whatever return you could get on $1 today, if you could get 8% at the stock market, then $1 today is worth $1.08 a year from now. So if we accelerate depreciation to make tax savings today, you can reinvest that money and have more money later. So that's the serious benefit of depreciation, where you can buy fixed assets. You can buy assets for your business, or you could buy a car. I have clients that purchase vehicles, or they purchase planes that they use for business. They take their clients out on their plane, or they take their clients out on their sailboat in the San Francisco Bay Area. They purchase cars for Turo, and then they rent them out and they start a new business that is almost completely passive, where they just list their car on Turo. They can even pay somebody to, do all the maintenance and pick it up and make sure that the renter gets it. And they're able to depreciate the entire purchase price of the vehicle through Turo car rental. You can do that with Airbnbs, doing short-term rentals. You could purchase a ton of inventory through Amazon FBA. So buying big assets or accelerating your expenses can get you a significant deduction that's going to help you save on your taxes this year. The auto deduction is one you likely know about. You can either take your actual expenses. Usually you only want to do that when you use your car over 50% for business, because that way you can write off 100% of the purchase price, plus any of your other actual expenses. It's fuel, maintenance, oil, repairs, registration, all those expenses you can write off. Or you can take standard mileage, which switched in July with the increased gas prices. The standard mileage rate is now 62.5 cents per mile. So per business mile that you drive, you get 62.5 cents of a deduction. The last common one that you likely know about is switching from an LLC to an S Corp. This is an easy one because if you make over $40,000 or $50,000, you pay self-employment taxes on that entire net income. When you switch to an S Corp, you only pay self-employment taxes on the amount that you pay yourself W-2. So a really quick example, if you have an LLC, you make $100,000 of net income, you pay about $15,300 in self-employment taxes. Let's say you have an S Corp, and that S Corp pays you a $50,000 salary. You still have $100,000 net income, but you only pay yourself a salary of $50,000. So you save the self-employment taxes on that remaining $50,000. Well, self-employment taxes are about 15.3%. times $50,000, you just saved $7,650 in self-employment taxes just from switching your entity structure from an LLC to an S Corp. Now, there are some administrative expenses related to turning from an LLC to an S Corp. It's about $1,500 to $2,000. So your net would be about $5,500 in savings. And that is why you don't want to become an S Corp until you reach about $40,000 to $50,000 in net income. So likely many of you have heard about these deductions. They're very well commonly known. Let's get into some of the lesser known tax deductions that could help you save thousands and thousands, tens of thousands of dollars each year. And we'll get into some examples. First is insurance, benefits, retirement accounts. So benefits like health insurance, disability insurance, those are deductible expenses when you're paying for them as a self-employed individual. How about an HSA? When you contribute to an HSA, you can deduct up to, it's actually $3,650 per spouse. And what do you get? Well, you get a tax deduction when you contribute it to this account. You can then invest the proceeds, invest the $3,650 in the HSA. It's a health savings account. And when it grows tax-free. When you use it on
representative, please hang up and dial.
When you use it on qualified medical expenses, you are able to take that distribution completely tax-free. So you're not paying any taxes when you use the funds of the HSA on your medical expenses, but you got the tax deduction when you contributed it into that account. So you're basically just writing off your medical expenses, which is not normally a deductible business expense. So an HSA, if you qualify, is an absolutely fantastic idea. HSA is a great one. Next, you have retirement accounts. How about a solo K or a SEP? If you're planning to save for retirement anyway in a taxable brokerage account, well, you might as well get the tax deduction related to saving in a brokerage account. So with an S Corp, you can contribute up to 25% of your W-2 salary. So if you pay yourself $60,000, you can contribute $15,000 plus $19,500. That is the employee portion of your contributions plus the employer portion of the contributions. And if you're just a sole proprietor, you don't pay yourself a W-2. Therefore, you can only contribute up to 20% of your net income to a solo K, to a 401k, or to a simplified employee pension. So those are retirement accounts. Of course, there's more details, but due to time restraints, we're not going to get super deep into it. Contact your tax professional. Likely you've heard about these ones. We're going to get into the less and less known deductions as we keep moving forward. So let's get into strategy number 2. Strategy number 2 is the home office. This one's great. I love the home office, love taking it for clients because oftentimes they do use an area in their home regularly and exclusively for business. I know I certainly have a spot in my home where I sit in the corner and all I do is do some work on it. Okay, so the IRS wants to see regular and exclusive use of some area in your home that you consider your home office. And there's 2 ways to calculate the tax deduction for this home office deduction. Number 1 is a simplified method, which I don't often use. And the reason why is because you oftentimes get more of a deduction with actual expenses. So the simplified method is $5 per square foot, and it maxes out at 300 square feet. So you can't get more than a $1,500 deduction for the home office using the simplified method. And that's why I have the actual expense method, which is way more often what I use. An example of the home office deduction is you take your total square footage of the office maybe it's 10 feet by 15 feet, you divide it by your total square footage of the home, say, for example, 1,500, and then you multiply that by your actual home-related expenses. So 150 divided by 1,500 is 10%, of course. When you add your rent, your repairs, your utilities, any other related expenses, it could be insurance, it could be taxes, it could be mortgage interest, all of those indirect expenses that you're already paying for your living, you get to multiply that by the total space that your home office takes up, and that is your deduction. So I've seen a $4,000 deduction, I've seen $6,000 deductions, because especially people living in the Bay Area, they pay a lot. They pay a lot in mortgage interest, they pay a lot in rent, and when you can write off 10% of your home-related expenses, that is a huge, huge deduction. So let's talk about what kind of documentation you need for the home office, because you can claim that you have a home office, but what if the IRS comes knocking and says, all right, time to show us some proof. Did you actually use that area of your home regularly and exclusively for business? What's a good way to prove that you had this home office? Simply a picture. So if you show them a picture and you have a little corner and you say, right here is a picture of the office that I use. You can see the computer, you can see my notes, you can see that it's not a couch, you can see that it's not a kitchen table. That is enough proof right there so that you can take the home office and you can show the IRS, and that will support the deduction that you're taking for the home office. So that right there, a picture of the home office, is the best way to support the home office deduction taken. I know of some CPAs that frivolously take this deduction. I know of some CPAs that won't take this deduction at all. The answer with every single one of these deductions is it's about the story that you can tell to the IRS, and it's about the receipts and documentation that you can give to the IRS. So if you have a picture and you have your rent payments or your mortgage interest statement and you have other receipts of your expenses for your utilities and your repairs to the home, you've got everything you need to show to the IRS, and they can't dispute that whatsoever. So that's the home office deduction. Find an area in your home that you can use regularly and exclusively for business, and you'll save thousands of dollars in taxes. Let's move on to strategy number 3. This is actually one of my favorite strategies, and the reason why is because I'm all about the entrepreneur's lifestyle. The reason why I'm an entrepreneur, the reason why so many of you guys are entrepreneurs, is because you want to have the freedom that comes with deciding what your schedule is, the freedom that comes with being able to pick who you work with, when you work with, how you work. And so for me, I love to travel because I can work from wherever. I run my firm fully virtually. I love to take out, my friends that I work with. They're my business partners. They're my clients. They're everybody that I work to. I pretty much only work with people that I know and that I care about. And I'm a relationship guy. So I'm able to take my friends out who are my clients or my business partners, and I'm able to deduct my meals. I'm able to go on trips to go meet with friends, and I have a business purpose. So if you like to vacation, if you like to go out to eat, if you want to write it off, you got to find a business purpose. And all of a sudden, if your marginal tax rate is 30%, you're getting a 30% discount on every time you go on vacation, on every time you go out and have a meal. So when you're traveling, here's some information. When you're traveling, you need to have a business purpose for each weekday. You don't have to have a business purpose for the weekends. The IRS says, well, nobody works on the weekend, so you can have a business purpose for Friday. You can have a business purpose for Monday, and you don't have to work on the weekends. So you can go do whatever you want on Saturday. You can go do whatever you want on Sunday, and you can still write off your transportation, your lodging, your meals. All of your travel-related expenses for the weekends are still deductible, even though you don't have a business purpose for the weekends. So you're able to write off all of these travel and all of these meal expenses, even though you're not working on Saturdays and Sundays, as long as you do the deduction sandwich, which is have a business purpose on Friday, have a business purpose on Monday. Now, if you're there for 5 days, Monday through Friday, and on Wednesday, only day you don't have a business purpose, well, all right, actually all of it is deductible because over 50% of that trip is deductible. Now, if you're out there for 2 weeks and you only have 2 days of business purpose, only those 2 days are deductible. So if you're going to be somewhere for 1-2 weeks, get a business purpose for every weekday. And now your entire trip is deductible. Same thing goes for business meals. When you're on travel, your meals, even solo meals, are deductible. When you're in your city, within 25 miles of your city, you're not on travel, you're at home, then you can write off meals as long as you have a business purpose. And you being hungry is not a business purpose, unfortunately. So you need to take out a prospect, you need to take out a client, take out an associate, or you need to provide meals for your team. You need to have some kind of a party that you throw, and you buy meals for everybody, and you bring all the food, and you talk business. Of course, that's a business purpose that is 100% deductible. So I didn't put this in the notes, but for 2022, 100% of meals at restaurants are tax deductible. It's been 50% since before I can even remember. Once we go to 2023, meals again are 50% deductible. When you go out and have a meal with a client, prospect, associate, we're 50% deductible. So let's continue talking about that. Here's my favorite strategy with optimizing your travel and meals expenses. It's called the board strategy. Did you know, even if you're a sole proprietor, you can have a board of directors? And when you have a board of directors, taking them on a trip, a company board meeting, or a company retreat, of course, you're going to discuss business, but you're also going to enjoy it a lot. And you can write that trip off. Now, your meals are deductible. Once a month, you're taking out your board to go talk business, and you spend $250 on a big meal, it's deductible. Because of course you're talking business, but whatever else you're talking about, it's not like the IRS can police that. So this is one of my favorite strategies, because you can maximize your lifestyle enjoyment with awesome trips, with awesome dinners, great experiences, while writing them off because you're doing business. And that's going to progress your business as well. I've been so many places, I'm going to struggle to remember everywhere. I've been in Miami a couple times over the last year because I've been going to conferences, I've been going to meetings, I've been meeting with clients, I've been doing presentations for InvestorCon, and I'm able to write off my tickets, I'm able to write off my meals, I'm able to write off these trips that I would have gone on even if they weren't deductible. But instead I get a 30% discount because I'm able to write it off. So let's talk about documentation for your travel and your meals expenses. Keep your receipts. Make sure you're recording your business purpose. When you go out to dinner and you get your receipt, the receipt already has line items. It already has the date and time. It already has, the location of where you ate. But what it doesn't have is who you ate with and what your business purpose is. So what I recommend is taking that receipt, writing who you ate with, and writing down what the business purpose is, taking a picture of it and saving it on your Google Drive or on one of the many apps that allow you to store your receipts, because you don't want to, bog down your photo library with pictures of receipts. There's many apps, including QuickBooks app, that you can store all of your receipts on there. Same with your travel. When you book a hotel, when you pay for a rental car, those are obviously, the receipts are going to be in your email. There's plenty of documentation there. As long as you have your business purpose recorded, you can write it off, of course. So let's get into strategy number 4. This is another great one. Brian, yes, we will be sending out the slides and recording. Feel free to send me a message. Feel free to book on my calendar. That's calendly.com/Anthony Price CPA. Don't forget the CPA. Strategy number 4 is Section 280A. It's the Augusta rule. So the reason that IRS put this in the tax code is because of Augusta, Georgia. They used to have the Masters golf tournament. And thousands, tens of thousands of people would come into Augusta to go watch the Masters. And so people realized it was a great way to make some money. They could rent out their house for a week, 2 weeks to somebody, make a killing. But then going to record this information for taxes became really cumbersome because they only were recording rental income for 2 weeks. It's not a rental property. This is my personal residence, but I could leave for 2 weeks and I could make $14,000. Why wouldn't they do that? And so the IRS had to figure out how they were going to account for this taxable income. Should we turn this personal residence into rental property and therefore the rules completely change. Man, that's going to be so hard. Why don't we just give them a break and say, all right, you can rent out your home for less than 15 days a year at fair market value, and you don't have to pay any tax on that income. So there's two elements to the section 280A Augusta rule deduction. Number one is the fact that you can rent out your house for 2 weeks, 14 days or less, and pay zero taxes on the income. So if you wanted to do that, if you live in Augusta, Georgia, or you live by Torrey Pines out in California, you live somewhere where you want to rent out your primary residence for 14 days or less, you can do so, and just the income you receive is tax-free. It does have to be reported, but it is tax-free. Here's the business deduction strategy. Well, what if the person renting your home was your business? Now, you're not giving up your home to somebody, you're giving up your home to yourself. You already live there, but now you're deducting the rent that you're paying yourself, and the rent you paid yourself is completely tax-free. So now you could receive, if fair market value is $1,000 a day, now you could receive a $14,000 deduction that you're paying no taxes on, that you're using to save taxes. Now, I know CPAs that blanket say, no way can you do this. I know CPAs that blanket frivolously allow all their clients to do this. Again, it's all about the business purpose. It's all about the story you can tell the IRS, and it's all about the records and documents that you have. So if you do it at fair market value, if you do it at 14 days or less, and you have that legit business purpose, you can absolutely take it. You can absolutely take it. Find some, comparisons on Airbnb, on Vrbo, or some co-work spaces that you can compare it to find that fair market value, and then find that legitimate business purpose. Whether you're doing a board meeting again, and then you can write off the meals that you bring in as well. If you're doing a company retreat where you're just having a bonding day where you're getting together and you're playing, you're having fun, let them bring their kids, everybody's having a good time. You're having a content shoot day. You block off the kitchen and you put up a background and you're doing content shooting, you're taking headshots, you're doing pictures, whatever it is. If you have a legit business purpose, be creative, you can absolutely write it off. So what kind of documentation do you need so the IRS says, all right, yep, that's good. Good strategy. I can't dispute that. Way to go. You just saved yourself $5,000 in taxes. The IRS wants to see a picture of the area you're using, some other proof that you actually did have this event. What's most important is having some kind of meeting notes. We had a board meeting at my house all day. Here's exactly what we talked about. Here's exactly the attendance that we had. So if you want a copy of meeting notes, if you want a copy of an example of meeting notes, I'll absolutely send you one. I have one that I send out to my clients that I create tax plans for. So all I got to do is write, all right, we had these 3 people here, and this is what we talked about for the couple hours that we had this board meeting. Here's a picture of my kitchen area that we rented out, and we just had this board meeting today, and you can't dispute that. You can do that every year, every single year, and you can have that same plan. We have a month is what I meant. Every month we have a board meeting. Every month we have a company retreat. Every month we have a content shoot day, and I rent out my home to myself for $1,000 a day. And at the end of the year, I got myself a $12,000 tax deduction. If your marginal tax rate is 1/3, is 33%, that's what, $4,000 of tax savings right there, just from living and doing business out of your own house. You can do that plus the home office deduction. Great idea. So that's the documentation you need. Section 280A Augusta rule is a great one. I love this strategy as long as you follow the rules. Strategy number 5 is hiring your children. This one is huge. If you have kids, this is like my favorite, the trifecta of tax savings. I'm really excited to get into. Think about yourself, your business, if you have kids. What kind of activities do your kids do in the business? Do they sweep the floors? Do they help you just close the envelopes and send your mail? Do they help your business in any way? Maybe they're a consultant. Maybe they're a board member. You can compensate that for them, because likely you're already paying for some of their expenses, their personal expenses. So if you're already paying for some of their expenses, you're already going to spend, $12,000 on them this year. How great would it be to be able to deduct that $12,000 by paying it to them as wages, and then you use that money that you paid them as wages to pay for their personal expenses. So now you're writing off the expenses you would pay for your kids. When they're under 18 and you pay up to the standard deduction, that's $12,850, you don't even have to file a W-2. The reason why is because you do a W-2, you have to pay unemployment taxes and workers' compensation taxes. But when you have kids under 18 years old, the IRS goes, all right, if they're your kids and they're under 18 years old, they're probably not going to sue you for a workers' comp claim because you're already paying for their insurance, or they're not going to be that concerned about unemployment because you're already taking care of them. So you do not have to file a W-2 for paying your kids under 18. You do have to file a W-2 for kids over 18, but still they're probably paying tax rate less than yours, plus the standard deduction of $12,850 means the first $12,850 you pay them, they pay zero taxes. And you can get a $12,850 deduction. So this one is huge. Of course, they have to actually be doing work in your business. They can't just not do anything in your business and you're paying them saying that they're, the CEO of your business and they don't actually do anything. They can't be paid a ridiculous hourly rate. My kid sweeps the floors for 2 hours a month and I pay him $10,000 a month. That's ridiculous. That's not reasonable in the circumstances. If they put 5 hours a week into your business, that's 20 hours a month, you can pay them $30 an hour. How much is that? That's $600 a month. $7,200 a year, $7,200 a year that you get to deduct for paying your one kid. Maybe you have 5 kids. It starts to add up pretty significantly. So when you have an S Corp, you would have to file a W-2, even if they're under 18, which is why you would start a family management sole proprietorship if you have an S Corp. This family management sole prop is basically your personal family office. Maybe they manage your rental properties or they help manage your family wealth, your affairs. So if you have an S Corp, you can get around the requirement to file a W-2 just by reporting that income on a sole proprietorship. It's really easy to do, just another Schedule C. Tax professional can absolutely help you do this. Let's talk about my favorite way to compensate your kids is a trifecta of tax savings. Paying your kids is a deduction for your business. Paying your kids is tax-free income to your child up to $12,850, and $10,000 beyond that is only 10%. So if you compensated them almost $23,000, how much would they pay in taxes? $1,000. That's less than a 5% marginal tax rate. That's really good. Here's the best part about it too, is teach them about entrepreneurship, teach them about personal finances, teach them about investing. How do you do that? By opening up a Roth IRA in their name. When they have earned income, they're able to contribute to a Roth IRA. They can contribute up to $6,000 a year into their Roth IRA. Think about the compound effect of $6,000 a year going into their Roth IRA for the next 50, 60 years. And then when they take that money out, it is completely tax-free. So you get a deduction, you save money by paying them. They don't pay any taxes. They invest it for the long term. And when they distribute it, hopefully by 65, they'll be responsible with their money too. And they're not paying any taxes on that money that's compounded for the last 50, 60 years. How great is that? So what documentation is necessary? Record their hours, record the duties that they do in the business, record the payments that you have, make sure you have proper documentation. And if you do that, there is no problem with taking that deduction, as long as you actually pay them, as long as they actually do some actual business in your work, as long as you have the record of what their hours and duties were. Now, here's a tip that I've learned from IRS audits. Of course, you should in real time record the hours and duties, but if you don't record it in real time, does that mean you just can't take the deduction? No. And in fact, you can take the deduction. In fact, I've seen IRS audits where the day before the auditor comes to our office and they say, all right, tomorrow I'm going to audit this payment, these wages that you paid to your kid. So just know that that's what I'm going to be auditing tomorrow. And so that tells us, all right, tomorrow we need to make sure we have this record of what their hours were, what their duties are. Same with the auto deduction. All right, so I see that you claimed $15,000, 15,000 miles of auto miles that you deducted. So tomorrow I am auditing your auto miles. They're basically saying, be ready for this audit. make sure that you have your records, make sure you have your mileage log. If you don't have your mileage log, but you did drive that 15,000 miles, get your mileage log, make sure it is ready. So if you're concerned, oh man, I don't have good documentation or records for, the expenses you paid for your kids in the past, or you don't have the picture of your home office yet, you can still go get it right now. So make sure to get that documentation ready to go. Again, it is so, so important. So let's talk about a couple testimonials and some examples of my experiences in helping people save money. It's my calling, it's my passion. I've spent so much time just giving away free game. I will continue to repeat the benefit of just having a free 15-minute intro call, because each of these deductions may or may not apply to you. So that's why you need to talk to me, and I'll just give you whatever game I can. For example, Shane right here, I work with a lot of crypto investors. And so Shane found me through probably the same company, Coffee and Crypto, who I have a great partnership with. I do their taxes, do a ton of their clients' taxes as well. Shane came to me with this problem because he spent hours on his own trying to do his crypto taxes and he couldn't figure it out. But after 5-10 minutes, I told him, well, why don't you try Coinly, where you're having an issue importing your transactions in this crypto tax software? Try Coinly, I think it'll work. And Shane comes back an hour or two later. He says, dude, I just fixed that in like an hour. And it's taken me hours to fix this. You didn't even charge me. It took you 10 minutes to figure this out. You didn't even charge me. If I can give you all the game you need in just 10 minutes, I'll give it to you. But if you need a whole tax plan because there's thousands and thousands and thousands of dollars in tax savings available, then we're going to work together. It's going to take a little bit more time, but that's exactly what I'm here to do. And that's why I offer the free 15 minutes, because if you're not a good fit, I'll give you some game and then we're off. So this video right here is me on Coffee and Crypto, where we talked about the strategy where I saved a client $300,000 in crypto taxes. Here's Madison right here, who's a friend. Her husband is a Navy pilot. My brother's a Navy pilot. So that's how I know Madison. She's a personal trainer. She came to me not having any tax plan, not having any tax strategy whatsoever. And I helped her save over $10,000 in taxes because she wasn't sure whether she could depreciate some of the equipment that she bought. She didn't have any home office deduction taken. She didn't have many of the strategies that we talked about, even though they were very good fit for her. So helped her save thousands of dollars. We're gonna get a couple more examples before we finish up and take questions. Next is Dallin here, who I absolutely love. He's an ex-NFL player. I think he played at Dartmouth in college, and I helped him set up his S Corp. I've been just consulting him so far. I just like him so much that we've worked really well together, and I'm basically advising his insurance company that he's building, helping him with his entity structure and any other tax deductions. Already helped him save thousands of dollars on his taxes. So a couple more quick specific examples of a tax plan that we put together. Client names have been changed for privacy purposes, but here are actual examples. We have Julie, who I started working with last year. She's a real estate agent. She had no tax planning. She actually prepared her taxes on her own. And she made $250,000. And she was scared. She didn't know what to do with her taxes. So she just calculated it and sent all the money, way, way, way more money than she should have been paying. So on a going forward basis, we decided, all right, we need to do an S Corp. She has a kid. She hired her kid. All right, put your kid on your board and your boyfriend on your board, and now go on some trips. Talk business, of course. How are you going to become a better real estate agent? How are you going to close more deals? And now you can write that off. Get an HSA. You have a kid, you got to take them, and they, of course, they have medical expenses. So contribute some money into an HSA. We implemented these tax strategies, and we saved her $18,152 on her next tax return. That is compared to what she was saving. To what she was paying. If she would have just kept doing her strategies, $0 tax savings. Now that she implemented my tax strategies, $18,000 in savings. Same with Dylan, who had an HVAC company, no tax planning at all, only $125,000 of income. But look at those savings right there, because he has to pay for his self-employed health insurance and his HSA, because he has a wife and he has kids. We did the Augusta rule, where he got with his kids and he did his board meetings at his home with his kids and with his wife. He invested money into a solo K. He invested money into an S Corp, or he changed his entity structure to an S Corp. We got him $20,000 in tax savings. That's crazy. That's so much. So this last one is an actual client as well. This is a screenshot from my tax planning software, which we're going to quickly talk about, where we were able to find $35,000 in tax savings. That is crazy. We're able to save most of his taxes. So you can see that when you go through actual tax planning softwares with an actual tax saving professional, you are going to implement strategies that maybe your CPA has not even told you are possible to save. So that's just a couple examples of tax saving strategies you can implement. I put together actual plans that look very similar to this. I put it through an actual software that comes up with the total savings that you're able to make. So what does that look like? What does that look like for you? And what's a quick summary of the final strategies that we implement? You can see the strategies again. I can give you guys copies of the slides. Feel free to send me an email, shoot me a message. I'll get you copies of the slides, send you a recording of this presentation. We didn't have time to go through every single one. We didn't go through, deferred compensation plans or defined benefit plans or some of the greatest strategies. We didn't go through private foundations or donor advised funds. So we didn't get to go through the hundreds of strategies that are right there in my tax planning software to see what tax strategy would be best for you. So I'm gonna give you the opportunity to book a free intro call on the next page just to see if we're a good fit. You are unfortunately not a good fit if I can't save you at least 3 times what your investment in me would be. So what does it look like to work with me? And again, if not a good fit, you can still take the information. What does it look like to work with me? Well, we start with a free 15-minute intro call, and I'll give you a little bit more information on the back end, but now is a good chance. You can take a look at the free 15-minute intro call, and then I'm going to go over basically everything that I do in terms of tax saving, in terms of tax work, tax planning, tax preparation, and with everything that I got. I actually want to go over some questions that I received in the chat. So if you have any more, please drop them down here. Let's see. So Devin was explaining cost segregation to someone last week, and they were saying that CPA doesn't recommend accelerating depreciation on real estate because you end up paying tax on the sale of the asset later, equivalent to the savings, implying you're just pushing the tax payment till later. Isn't that the point? To delay paying the tax as long as possible. Take advantage of time value of money. 100% it is. So I'm sure that was inspired when I talked about the time value of money play earlier, because tax savings now, giving you money in your pocket right now, is worth more than tax savings later. If it's going to be the exact same amount 5 years from now, having $10,000 now and you're able to make a 10% return. I mean, let me just calculate that real quick. I mean, that's a 10% return. You're going to almost double your money in just 5 years. So if you can make $10,000 now instead of $10,000 of tax savings 5 years from now, absolutely. That's the exact point of cost segregation studies. Accelerated depreciation doesn't give you any more tax savings than you would, if you didn't accelerate it. You still get the same amount of depreciation, but having that money now, is it going to be a down payment on your next house? It accelerates the depreciation, accelerates the tax savings, and accelerates the cash flow in your pocket so you can make more moves on your wealth. So when you accelerate cash now and you defer paying taxes until later, then you can have that cash flow to grow your wealth now, because it's a time value of money play. Money now is worth way more than money 5 years from now. Brian asked, if my wife and I both have separate S-corp businesses and work from home sometimes, is it better to split the home office deduction to just one of us? Good question. I would say just one of you guys. If you have 2 separate offices, maybe one of you gets to claim the main office. Maybe one of you has a little desk that's pushed to the side. It's not your kitchen table, but it's next to your kitchen table, or it's in your living room. Maybe you have 2 home offices that you're able to deduct. I wouldn't claim the same home office for both. You can only take, if you have an actual room, an actual office, you only take that one time. But if you also have a little corner that you also use for business, when Brian's on a call and his wife has to do some work, she's in the corner, so she uses that corner for business, 2 home office deductions. So Carter asked, he missed the follow-up question, is strategy 2 available to somebody that rents? Absolutely. Whether you own the home or whether you rent the home, you can take the home office deduction. The calculation is almost no different too, actually, because when you rent and you do the home office, you get to write off. Our example is 10% is how big the home office is in the home. So let's say 10%, and let's say you pay $3,000 a month for rent, $36,000 a year, you get to write off 10%. That's a $3,600 deduction just based off of your rent. What about if you pay mortgage interest? Let's say you just bought the house, so you paid $12,000 in mortgage interest. Of course, you get to write off 10% of that. If you wanted to, which I have absolutely done for clients, especially ones that own really big, fancy homes in the Bay Area, we wrote off part of his home as depreciation. So not only can you get that 10% of your mortgage interest, but you can also write off a part of your home as depreciation, which was a massive benefit. He was able to take, that was one of my clients that had a close to $6,000 home office deduction. So the answer is someone that rents or someone that owns, absolutely, you can take the home office deduction. Awesome. Let's see. And finally, Jessica said, we're picking up a Tesla Model X next week. Depreciation method would be best for us. And what's the max we could write off against our taxes in 2022? If I remember correctly, the Model X is actually over 6,000 pounds of gross vehicle weight rating. The IRS says any vehicle over 6,000 pounds is classified as a cargo vehicle, and it's eligible for that bonus depreciation, which in 2022 is 100% of the purchase price you can write off. Even if you buy it on loan, you can write off 100% of the purchase price of the vehicle. So let's say you put $5,000 down for this Tesla Model X, and you buy it for $100,000, just totally hypothetical. You can still depreciate and take a deduction for $100,000. What if that $100,000 deduction just saved you $25,000 in taxes and you spent $5,000 for it? Yes, again, this is a time value of money play, but you just cash flowed $20,000 if you invested that into crypto miners or some other asset that's going to also create passive income, or just invest in yourself, coaches, marketing that's going to help you increase your income. You're going to be able to compensate for the tax you have to pay later with any income increasing moves you make now. So yes, with Tesla Model X, very likely you could write off 100% of the purchase price, whether it's for your business, whether it's for Turo rentals. It does have to be over 51% for business use. So that's questions. Here's how to work with me. I want to be transparent about how everything works. When you have the ability to make minimum 3x ROI, I will help you with a tax plan. Generally, this is how it looks in terms of the tax savings and tax cost. And the reason for that is because I spent a lot of money on my tax planning software. I spent a lot of money on my tax preparation software, and I spent years. And my team and I have decades of education and experience in specifically these tax saving strategies. So if we're able to get you at least 3x ROI, as high as 10x, hopefully more, then we will create a tax plan for you. If not, we won't make a tax plan for you. I'm sorry. It's just not a good fit because there's too many people to make tax plans for that will make a good ROI. And again, we only have room for about 5 people to do this because it's extension season, and then it's tax planning season for our current clients, and it's getting ready for tax prep season coming. It's 4 months, 5 months away. But we got to get ready now because it gets busy. It goes really fast. So what other ways are there to work with me? Crypto tax planning and preparation, simple tax preparation. And if you make over $200,000 in net income from your business, I help people save crazy amounts of taxes with charitable strategies and with trust strategies. So if you fit into any of these work categories, then I'm more than happy to work with you. And if it's not a good fit after having a free 15-minute intro call, unfortunately, then it's not a good fit. But I'm still happy to spend 5, 10, 15 minutes with you just to explain what my honest perception of your situation would be. So Jessica again asked, whatever we pay you in preparation is also a tax write-off. It is if you have a business. If you're just a W-2 employee, not deductible, but the majority of you are here because you're business owners. And therefore, yes, paying me for tax prep is absolutely a tax write-off. So we did pretty good on time, honestly. It's 11:57. If there's any more questions, please let me know. I'm gonna go back a slide so that you can see my free 15-minute intro call here. And Justin, I'm definitely gonna shoot you an email. Guys, please sign up for the free 15-minute intro call. More than happy to help you guys. Send me an email, anthony@priceless.cpa. I'll actually drop that in the chat right now. And if there's any more questions, I'm more than happy to answer it. Thank you guys so much for attending. Follow my socials. I drop a lot of good information on Instagram, on Twitter, on TikTok. I don't really read the comments. It's a little toxic sometimes, but I'm on Instagram, I'm on Twitter a lot. You'll find me through LinkedIn, most likely. But I'm also on Twitter and Instagram. That's where I'm most active, sharing really good information. You'll find a lot more awesome stuff there. So keep up with the story. If there's any more questions, happy to answer. But we are just about out of time. Really appreciate you guys for coming on to the webinar. It was a lot of fun. Love talking about this stuff. Love helping people save tens, hundreds of thousands of dollars in taxes. And you guys have been a fantastic audience. So thank you guys so much. Alrighty, we're about to end the recording and hop off. Looking forward to hearing more from all of you guys. Thank you so much. Take care, guys.